episode 198 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everyone, before we get started today, I want to thank our sponsors. CME Group, Trading Technologies, RJO Futures, and Top Step Trader. Now today I spoke with Nick Radge, Director of Trading and Research at Trade Long Term. To kick things off, Nick tells us how he got his start in trading futures markets. We chatted about how Nick has transitioned from trading futures to trading stocks. He explains how he uses the trend following and momentum strategies that he's been using for years to trade futures, and how he now uses them to also trade stocks. We discussed a lot about systemic trading, from his process to building a strategy, backtesting it, and then turning it live. Finally, we had a great discussion about the psychological side of trading. As usual, thank you all for listening, and please enjoy this episode. Nick, welcome to the show.
Thanks, Anthony. Thanks for having me on.
It's great to speak with you. It's always great to speak with someone that I met on Twitter, who I followed, read a lot of the things you put out there. I really enjoy your commentary and have a chance to speak with you.
Yeah, and we've got a lot in common. You worked on the trading floor over there in the US for a number of years, and I worked on the trading floor in futures over here for a number of years. I visited those floors, a little bit different, you guys, much bigger, but I have great memories of those trading floors, that's for sure, in Chicago.
You and I were talking about this prior to getting online today about me making the trip over to Australia, and we were just talking about it's quite the journey. I know you've been over here to the States, but at some point I'm going to be out there, I'm going to meet you, and then I'm going to have you show me around. But for today, we're going to be doing this over the phone, not in person. So Nick, I'm always interested in how people got their start in the industries. You're in Australia. I don't know how much financial industry is really going on over there in Australia, but yet I know there's a great number of people in Australia that are trading in financial markets. So I'm always wondering, how did it all begin for you? How did you get your start in the financial industry?
Yeah, accidentally, put it that way. I had no plans to get into it in any way, shape or form. I was an average student at high school. I didn't go to college or university. I just, a friend of a friend worked at a stockbroking firm. They needed a clerk to push some paper around. He offered me the job. It turned out that the job was actually pushing futures papers around, just doing the back office stuff for a little futures operation that operated in the money market side of this stockbroking firm. And so I started doing that. And then one day I was walking through the advisory section on the stockbroking floor, and there was a guy there, one of the advisors, plotting a 5 and 10 day moving average crossover on the index futures here in Australia, which is similar to your S&P 500 over there. And this was back in 1985, and back then the stock market was ripping along, and I could see the trends, I could see what he was doing, and by that afternoon I'd gone down to the local stationery shop and bought my graph paper and a red pen and a blue pen and a black pen, and I started plotting the market and doing the 5 and 10 day moving averages. And then I asked the old wily office manager who'd been around forever and seen fools like me before, asked him if I could trade the share price index futures, and he just kind of shook his head and think, here we go, this 18-year-old. And that's how I started. And it was all accidentally. I lost everything in 1987, as a fool would do that doesn't know what he was doing. But that's basically how it started for me, and I've been trading ever since.
Yeah, I mean, a lot of similarities to myself. I got in the business accidentally as well. And, you know, one thing that you're doing now that I have tried to do and I've struggled with it is you're transitioning from futures to stocks. And I can tell you from a personal standpoint, I'm the first to admit I'm nowhere near the trader I am in the futures markets. I think it's just because I can't wait to cover winners. And you have to have a little bit of a different mentality, I think, when you're trading stocks versus what you're doing in futures. So I'm curious, how are you doing with adding stocks to your trading?
Look, it's a good argument to add stocks to your trading. We run, for example, I run a mentoring course, and some of the guys that come into the course have been trend following in the futures space for a number of years. And as we know, that's been a very difficult few years, trend following in futures. And they needed to diversify, and that's their argument. It's diversification. And I'm all for diversification across different strategies. I mean, I trade 6 different strategies, albeit they're all stock strategies. But I think if there is a holy grail out there anywhere, it's the diversification across different strategies, especially if you're a systematic trader like me, for example. So what we've seen is people transition from futures into stocks to diversify. And also, the volatility of the futures markets these days is significantly more than what it was, 15 years ago. 15 years ago, gold would move a couple of bucks here and there, but now, $30, $40, $50 night's not a problem. So diversification's a big thing. For me, back then, it was a business decision. I was a CTA. I was running money using trend following strategies in the futures markets. But I saw that to get new money in, people were scared of futures. They didn't understand them. They thought it was all gambling, but they understood stocks. So for me, it was a business decision from a money management perspective, to move into managing money on an equities-based portfolio rather than a futures-based portfolio.
So talk to us about how the transition has been. I know that you were a CTA and you're using trend following and momentum strategies in futures. Are you using those same strategies for stocks, or do you have to go back to the drawing board?
I still use the same. My main trend following strategy for the Australian market is exactly the same strategy I used to trade futures back in the 90s. And I've been using that exact same strategy ever since. It hasn't changed a great deal. The basis of it is still there. And look, robust trend following strategies should be like that. They should work across a number of different markets and different ways. So to answer your question, yes, I'm still using the exact same type of strategy. I have added more strategies into there. I'd say 80% of my assets in the markets are allocated to trend following or momentum style strategies.
Interesting. I want to pick your brain a little bit because I know you talk a lot about systematic approaches to trading, and you've developed these systems. And I've gone through this in my world where I've tried to build my strategy. I've tried to automate it, and it's tough. I mean, it really is. I mean, I've been a discretionary trader my entire career, and I've tried to get involved with developing systematic approaches, and I always come back to it where I end up executing the strategy better than the machine because I know when to trade it big, I know when to trade it small, and I know when not to trade it at all. And I've always felt that that's very tough to program. But you've been very successful at it. So talk to us about the process. How do you go about developing, testing, and then taking strategies live?
I think one of the reasons why I've been successful at it is because I'm a really crap discretionary trader. I've tried it. I had a lot of friends come off the trading floor whom, were scalping on the trading floor minute to minute, that kind of stuff. And I just couldn't do it. I tried it once. I remember back in about 2000, one of my best mates was making a lot of money doing that. And I thought, I'll get into this. And I think I lost 30, 40 grand in the space of 2 weeks. And I thought, nah, this is not for me. And I just know it's not for me. Systematic trading is not for everybody. I have guys that work for me who don't trade systematically. They just can't. They just don't like that. They want to make their own decisions like you do, and that's perfectly fine. But I guess I've been programmed from day one. When I said before, I walked through that stockbroking office and 5 and 10 day moving averages. That was my introduction. That was basically, albeit rule-based, but some kind of a system right there. And that's the way it's always been. I guess I got significantly more into systematic trading when I read a book by Curtis Arnold called PPS Trading. Now, we won't read good things about Curtis Arnold, but at the end of the day, his book was a rule-based systematic approach, and that put me deeper and deeper into it. And that's when I bought my first software back in the early 90s, and I would start programming. I would spend, 2-3 hours every single day doing that. And it's just developed over time. And I now have a programmer full-time on staff, and I've moved different programs over time. But yeah, I can't trade discretionary. I'm no good at it. It makes me feel uncomfortable, and I want to have a validated, evidence-based way of trading. It gives me confidence that I have a place to get in, a place to get out, and the computer is going to know that historically over a large sample of trades, well, it may not be optimal, but it's the best way over the longer term. Just this morning, as an example, I got an email from a client. He had been on a trade using one of my systems. He was well in the money, and eventually he took a break-even trade. Now he's very disappointed at that, very unhappy about that. And I said, well, the thing is, you're taking a single data point, but if you extrapolate that over hundreds and hundreds of data points over many, many years, you'll see that what you're doing is actually the right thing to do. In this one instance, well, it is what it is. So systematic gives me confidence because I can backtest everything and I can fully understand what the system, what I'm doing, what it can do and what it can't do. I know what my worst drawdown is going to be. I know how much trading I'm going to do. I know what's going to happen in certain market situations. And if I know that and I accept that, well, I'm going to be in a much better position to be able to follow through. And so long as I follow through, then I'm going to be profitable according to what the system rules are telling me.
Okay, a few things I want to dig a little bit deeper on. First thing you said was that you're sticking to your strengths, basically. You know who you are as a trader. I feel more comfortable on the discretionary side, although I do use some automation for signals, but I like to be the one who's pushing the button. So once again, I stick into my strengths, you're sticking to yours. And then what I always have believed is that there really is no right way to trade. It has to be the best fit for that particular trader. I mean, every trader is not going to be the same. Even if you and I both agreed on a strategy that we liked, how we executed, it's got to be within us. And I think that, you and I both agree with that. But I want to talk about process. Mm-hmm. I want to know how you begin to decide what strategy you're going to develop. Like for me, because I was a scalper, I'd gone through a bunch of different indicators. I kind of sat back, evaluated myself, created my own indicator, and then from there I created a strategy. How does it begin with you? Is a pattern you're looking at as an indicator? How do you go about getting through that first phase of the process?
I'm not sure I'm a good example because, as I've said, I was exposed to trend following. That's my bias right from the get-go. But for someone new to it, my advice would be that go with what is immediately in your mind, what kind of makes sense to you. You're going to have bias. You're going to have a belief about the market, whatever that may be. Everyone's beliefs about the market are completely different. If you have a belief that you can't hold a position overnight, as an example, that's a dangerous thing to do, well, for me to push that onto you is going to be difficult for you psychologically to execute. So I think first and foremost, the place to start is you've got to create a strategy around your own personal beliefs. That's the only way it's going to work for you. If you believe the market is mean reverting or that you have to buy weakness, for example, rather than buy strength, then that's the way you've got to pursue it. And I think you've got to build on that. Ideally, you build on that using an evidence-based approach. It's all good and well saying, I'm going to buy the dip, but if it doesn't work for you, well, you've got to prove that to yourself first. I mean, I'm a very big believer, and if you can't prove that it's going to work, well, don't even start trading it from the get-go. Obviously, being a discretionary trader, that's very difficult to do, but from a systematic approach, I want to see that the thing makes money before you even put a cent into it. So I think to answer your question, you've got to go with your beliefs, because deep down, subconsciously, if what you're doing is not suitable for you, then you're not going to be able to execute it over the longer term. And you're certainly not going to be executed when you go into a drawdown phase or when things get very difficult. That's the tough point right there. You've got to be able to push through. And the only way to push through is knowing that the process that you're following will be profitable. Does that kind of make sense?
Yeah, it does. I mean, you're so right. It has to be within you as a trader. You have to believe in what you're doing, and you have to be executing the way that you're most comfortable. But there's one question I have that this is something that I struggled with. I've been discretionary, but I've created some strategies, automation, and I would backtest them, and boy, they look good. But then when I put them live, they weren't so good. So I guess what I'm trying to figure out is, how do you go from backtesting something and then putting it into live trading? Because I had a lot of issues where the backtesting showed me one thing, and then when they went live, it wasn't nearly as good.
Yeah, well, there's a lot of reasons for that. I mean, running a backtest and running a backtest properly is two completely different things. There are a lot of problems that can occur, a lot of biases, a lot of errors, a lot of robustness situations that can occur. And I think you need to be aware of all of those. And one of the things we do, we try and break our systems. You know, we don't try and make them better. We don't try and look for the holy grail. What we're trying to do is disprove what we're doing. And if we can't disprove what we're doing, then maybe, just maybe, we could be onto something. So to give you an idea, right, let's use a very simple idea whereby, let's say we've got let's call it a moving average crossover where you get a 20-day crossing over a 200-day in your buy, right? What we will do is we will obviously optimize those parameters to ensure that there's some kind of statistical flat spot around those parameters. That's basic stuff. But we'll also go and change the prices on the day. We'll just use random prices on the day. So, you know, we might adjust the close price if we need a close above the moving average, as an example. Well, what happens if we adjust the close price by random up or down 2% on the day? We try and do those kinds of things with randomizing the trade selection, for example. We randomize the trade sequence, which is kind of bootstrapping. We increase signal variance. We increase data variance. These kind of things to kind of interrupt the data and disprove it. And if you can do all that and the thing still makes money, well, then you're onto something. But clearly, you've got to come back to some of the basics. The system has to be robust in the first place, okay? Optimization and curve fitting has to be done correctly, if there is such a correct thing to do, curve fitting. But you've got to take into account other things as well, like post-dictive errors. That tends to be a very big killer for trading systems that you see out there. So there's a lot of things that can go wrong. And when we get into stock trading, there's even more things. For example, in the futures market, what have you got? 50, 52, 55 different futures markets these days, where when you get into stocks, you've got thousands and thousands. So you have other things come into place, like selection bias or incorporating historical constituents and delisted stocks and that kind of stuff. So there's a lot to know and there's a lot to understand, and therefore there's a lot to go that can go wrong. One of the biggest pieces of advice I could probably give is to a new trader is to really understand why your strategy is going to make money. Just bring it back to the very, very basic core. Why is this strategy going to make money? Now, with trend following, it's a reasonably simple argument that prices must trend. They can't not trend. To suggest that a market can't trend would suggest it's going to be fair value all the time and that there's not going to be any investor sentiment pushing it one way or another, which we know is just impossible because throughout history that's the way it's always been. So markets must always trend. And as a result, we can ride those trends and we make money simply by keeping those losses as small as possible. And when we get on a winner, we ride it for as much as we can. So the explanation of a mathematical edge with trend following is actually pretty simple, in my view. But if you can't explain why your system is making money, then I think you're going to run into a lot of problems down the track. Simple works very, very, very well. But, if you say this indicator is above here and gold's doing this and it's a Wednesday, then there's no logic behind that kind of a strategy, and it probably is curve fitted and won't work into the future. But you need to understand why. If you can't answer the question why my system makes money, then you're probably knocking on the wrong door.
Yeah, no, a lot of great points, Nick. And I go back to my personal experience. When I first started doing this, and I go back to the back testing, the mistakes that I was making, once again, I think that I was not fully invested in my mind also to go automation. I was kind of like just trying it and seeing, how some of these would work. And I put a few of them live. And the biggest issue that I came across on the future side was, because I was an active trader, was getting filled. When you're doing the back testing, you're getting filled in a lot of these. And it was pretty funny, because we were sitting back looking at it going, boy, it's amazing how we could be the high or low ticket in so many different times. And you're like, wow, you think when it trades down there, in the S&P or something, that the likelihood of you getting filled should be pretty high. And then you go live and then we weren't getting filled, or, just little things, little nuances I was learning so much about. And so you made an excellent point in saying that you really have to know how to backtest. That's why it's like, do your homework about every aspect of the process to make sure that you are doing it correctly. And I've made a ton of mistakes. I'm open about them. I get it. I know it when I've been applying a systems approach. What are some of the common errors that people make and traders should be aware of before they start to build a system?
Well, I think robustness and the system has to be reasonably robust. And I think, there's some great interviews out there with traders that are even going back to the old days, the Market Wizards books. If you read between the lines, rather than just read the words, read between the lines of what these guys are telling you, and you can really get some insights. I mean, someone like Jerry Parker gave an interview recently, and I've listened to it 5, 6, 7, 8 times, and it's true wisdom, but you've got to listen carefully, listen to what he's saying. For example, robustness, keep things very simple. They're not going to be optimal. They're not going to be a straight line equity curve or anything like that. There's going to be bumps in the road. That's the way trading really is. But I think people strive for the perfect system, the one that's going to make money 80% of the time and have a nice equity curve and make money every day, every week, every month, every year. It just doesn't happen like that for the majority of people out there. And it doesn't have to happen for the majority of people out there to be very, very wealthy from doing this kind of stuff, So I think before you start, it's like everything, I commonly get a phone call from someone saying they want to learn and they want to trade for a living. And I remember I got a phone call last year from a guy who said, he's never traded before. He wanted to trade for a living. And I said, okay, do you play golf? And he says, yeah, I play golf. And I said, so, do you think you could be on the US tour by the end of the year? And he said, oh, don't be stupid, blah, blah, blah. So, well, it's the same kind of thing. You've got to put in the 10,000 hours. You've got to put in the hours to make it work. You can't just pick up a book, read a book and go, bang, that's what I'm going to do and it's going to be successful by the end of the week. It just doesn't happen like that. So I think you've got to take it seriously. As you said, you've got to want to take it seriously. I spend hours researching. My trading doesn't take that long. Literally, I put my account balance into my software, push the button, it spits out the orders and I'm done for the day. Literally 5 minutes. But it took 25 years to get to that stage. And I think if people want to get into the trading side of things, whether it be discretionary or systematic trading, you've got to learn everything about it. And you've got to learn about survivorship bias, sample bias, selection bias, post-dictive errors, all these kind of things. And they're important to know and understand and appreciate and respect, because if you write a system that has some kind of a post-dictive error, well, straight away you're gonna realize. And one of the big tests that we do before we take a system live is we'll run it through a simulated account, and we will run a back test every single day aligned with the real-time trading to ensure the trades and the prices are exactly the same. And we'll do that for a period of time. And if you've got a post-dictive error, well, you're going to see very, very quickly that, oh, hold on a sec, I should have this trade and this trade, but I've got that trade and that other trade. So, running simulated trading side by side, a back test, walking forward is a great thing to do. But I think bottom line, you've got to take the time. You've got to put the work in. You've got to put the hard work in, because there's a lot of people out there who are very, very smart, and they work hard and they research hard, and as a result, they're successful. But if you want to take a few minutes a day to think you're going to be a professional trader, it's unlikely to work.
Yeah, so true. And getting back to golf, I'm doing my very best, Nick, to get my 10,000 hours in in golf these days. That game is, I tell you what, going through becoming a day trader, I think was almost easier in some ways. But the game of golf is great. Something you talk about is overcoming yourself and having to surrender to the market and know that you truly have an edge. I've heard you speak about this. Talk to us about that.
Yeah, it's interesting. I'm told, and I've had several kind of evaluations done, but I'm told I have a particularly good psychological makeup for trading. What that specifically is, I don't quite know. But I just don't care about losing money. It sounds strange. I just don't care about losing money. Many years ago when we were managing money, I remember doing a talk to a whole bunch of high net worth individuals that were brought together by a bank that was allocating money to us. And one of these individuals walked up to me afterwards and said, I can't possibly give you money. You clearly don't give a damn about my money. So I sort of do, but you've got to be detached from it. And I think that's an important thing, to be completely detached as you can from the money, because at the end of the day, so much of the emotional decision making that takes place is surrounded by the money involved. I think we just put so much emphasis on the money, which is ironic, because one of the things we want to do when we get into trading is make money. But I think the more you can detach yourself from that, and I think, you hear this old saying that only trade with money you can afford to lose. My feeling with that is that's detachment, complete detachment. Here's $50,000 and I don't care if that goes, and I don't care if I lose that. And if you can truly be in that position, then I think you'll be a lot more successful, because I know that when there are decisions to be made based on emotion, usually you'll make the wrong decision. And let me give you a recent example about being completely detached from it. When President Trump was elected, that night he was elected, I was 100% long in two of my US equity portfolios, and I'm sitting here and I can see the S&P was down 100 handles in the night session, and it was more like it's going to be an interesting day tomorrow. And I woke up in the morning, and then we were up that day, we were up 150 points or something ridiculous, and it's like, whew, there you go. If I'd been emotional about it, I would have gone in there and I couldn't have got out of my stock positions, but I could have hedged. And in fact, I got an email from a client saying, if I wasn't trading systematically, I would have been getting out of those positions and woken up today and I would have lost all that money. So I think if you can really ignore the money, and that's a very difficult thing to do, it takes a lot of training, but if you can really detach from the money, you'll then become a lot less emotional, and I think you'll become a much better trader.
So I have a little bit of a different mindset, and I had a little bit of a different experience in my life. I remember when I first put in my $25,000, and I only focused on winning. And then I ended up going through another $50,000 of borrowed money. And after I blew those three accounts, I was down to my last $10,000 account that was borrowed, so now I'm in debt. And that's when I actually started to make money. And for me, it was because I either had to make money to stay in business, to be able to eat, or I was out. So I feel like at that moment, I finally learned how to manage risk. So I think it goes back to, once again, there's no exact way for any person to come in and find the answer. You have to see what works for them. Because for me, when I start not to care, I start to lose a lot more money. But when I come in and I play a little bit defense, play more defense, and I'm a little bit more picky, and I find I have to force myself into a trade, is when I trade better. So I think that, and once again, it's just a different style and approach. But it's interesting hearing that from you as well, because I really can't disagree with what you're saying. But I think that it comes down to me as a trader and what's worked for me and what's not worked for me. It's just different.
Absolutely. And, I think if anyone stands up and say my way is the only way, well, you just run the opposite direction as fast as you can.
Way. Yeah, 100% agree with you.
You get that with a lot of these fundamental value investors and that kind of stuff. And, I regularly, I got bombed the other day. I was on TV and I was on with a fundamental value investor. And interestingly enough, he was very kind on the show, no problems at all, but I read an article he'd written about some of my comments just the other day, and it was like, oh, really? Gee. And he was basically saying, without using my name, that I was full of shit, and excuse the French there, but and I was quite taken aback, because he's a market professional, he's been around a long time. He should know that, hey, the momentum anomaly is a known thing. It is a known and academically widely studied market anomaly that works. It's proven to work. Yet he's saying it's all garbage and blah blah blah, and that's fine. But it's just disappointing that he's written this to his investors, saying these people who are doing this are fools, and it's better for us and whatever else. But it's just ignorant of the bigger picture of what goes out there. And as I said, anyone that stands up on a pedestal and says my way's better than yours, well, good luck to them,
Yeah, absolutely. I mean, I respect everyone in this industry because I know how tough it is. I know how much hard work I've put in, and anybody out there who's trying to do this for a living, you have to respect what they're doing. And what works for them may not work with you. You may not agree with it, but that doesn't really mean anything to them. They have to believe in it. You and I have been talking about this this whole interview. If you're not doing something you don't believe in, then it won't work for you. So I think so much of this business is psychological, that you have to go through this with your own money and take those steps that you and I have taken to actually see who you are and what it's going to take for you, to be successful in this business.
Sure.
Yeah.
Absolutely.
Excellent insight today, Nick. But we're not done yet. I have some rapid fire questions if you're ready for those.
Go for it.
All right, everyone. Our rapid fire segment is sponsored by Trading Technologies. You can access the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. And now you can trade cryptocurrency spot and derivative markets side by side. For more information, please visit tradingtechnologies.com. Nick, first question. What trader has influenced your life the most and why?
Ooh, I would say Curtis Arnold. And he really put me on to a real systematic, rules-based systematic approach. So Curtis Arnold, I think, that would be number one. Number two, believe it or not, Russell Sands. Gosh, both these guys don't really have good reputations in the market, but there you go. Russell Sands, he was one of the ex-Turtles. I think he got booted from the program, but I listened to him speak once in Singapore, and he was talking about the 2% risk rule, which I'd never heard of at that point. And to me, that was a revelation, and it really added a missing ingredient to what I was missing in my own trading. And, it comes back to risk management. So, Curtis Arnold, Russell Sands.
What was one of the hardest things that you've had to overcome in trading?
Forgetting about the money. I think that's one of the hardest things, becoming unemotional, unattached to it all, just letting the process of following the system do what it's got to do, regardless of the immediate outcome, and knowing and understanding that over the longer term it'll be okay. So I think detaching from the money and becoming as unemotional about it as I can.
How has your trading evolved over the years?
I've moved more and more systematic. So it used to be rule-based systematic. Now it's completely systematic. Literally, where, as I said before, put the account balance in my software, push the button, and it generates all the orders, does the position sizing, places the orders, etc. And I've added a small element of mean reversion on shorter term stuff. So I run two strategies that are mean reversion. One is a day trade strategy, again, fully systematic, and another one is a swing system, which lasts 2-3 days. But only about 20% of my assets are allocated to that. But yeah, that would probably be a bit of a shift, and that's about system diversification more than anything else.
What's the number one resource you spend your time on?
Probably Twitter, because there's a few people I follow on there who are pretty smart. Guys like Morgan Housel, Urban Carmel, for example, Bespoke, these kind of guys. They talk smart, they talk interesting stuff. It doesn't impact my trading in any way, shape, or form, but it's interesting to read what these guys are talking about. So that would be much of the reading that I would do through those guys.
What's your favorite book about trading or the markets?
I'll say Complete TurtleTrader by Michael Cavell. That really resonated with me. In fact, it resonated with me when he first released that. I bought every copy in Australia and gave a copy to all my clients. And I think it's just a really, really good book.
What's your favorite movie or TV show about trading or the markets?
I don't think you go too far past The First Wall Street. The Big Short was good, but The First Wall Street was great.
What's the best piece of advice that you've received about trading or the markets?
Yep, that's a good one. I visited some friends of mine who are running a hedge fund, and all around their office, they had these little sticky notes. And on the sticky notes, it said next 1,000 trades. You went into the bathroom, and there it was sitting on the mirror, next 1,000 trades. And it was a reminder to them that not a single trade is going to make or break them. They got to take the long view, that kind of stuff. So that's probably the best advice I've ever, not given, but was shown, and have taken it on board. So next 1,000 trades.
Now, if you could give a piece of advice to the new people interested in getting involved in trading, what would it be?
I would suggest that if you're interested in getting into trading, longer term trend following is probably the most robust way to go about creating a positive expectancy. There's a lot to like about it. It's low turnover, so commission drag is very low. In equities markets, there's a lot of opportunities. There's always something trending. And in terms of time taken, I think, to be realistic, you want to raise a family, have a career, then scalping the E-minis after work for a couple of hours is probably not the smartest thing to do. But running a longer-term trend-following kind of portfolio across equities, even an aggressive version, can give some very, very good results. Low time consumption, and you can focus on the other things in life that you really are important to you. So that would be my advice, and obviously it's the easiest way, in my view anyway, to create a positive expectancy.
Last question for today. If you weren't involved with trading in the markets, you'd be doing what?
Well, I think the truth would be I'm probably in the corporate world where all my mates still are from many, many years ago, still doing that same kind of stuff. I'm sure I just would have been dragged through that. I guess in my dreams, maybe professional fisherman, something like that, something outdoors. But I'd be in the corporate world, I guess.
Where can people find you on Twitter, and give us a website to check out?
Look, the best place to find me would be tradelongterm.com. You can get free access to my momentum scans and that kind of stuff that I use for my systems in there, completely complimentary. And there's also an educational webinar in there as well on momentum investing. So that's tradelongterm.com. And On Twitter, you can reach me via the Chartist. So at the Chartist. That's my main Twitter handle at the moment.
Yeah, everyone, I highly recommend you go and check out Nick's website and follow him on Twitter. He's a great guy and gave us great insight today, Nick. Thank you so much for coming on Futures Radio Show.
Pleasure. Thanks for having me, Anthony.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.